Hi guys, welcome to my YouTube channel. Here I am back with another informative video. So the topic of the discussion is how to use real estate cost segregation to save big on taxes. Beginner's Guide 2025. So we will discuss how cost segregation reduces your tax bills, a comprehensive guide. So when comes to introduction in real estate investing, knowing how to take advantage of tax benefits can make a big difference to your bottom line. Cost segregation is a strategic tax saving tool that accelerates depreciation deductions and thereby improving cash flow and reducing tax liabilities. This blog explores the intricacies of cost segregation, offering insights into its benefits, methodologies, and practical applications for property owners. So first of all, we will discuss that what is the cost segregation. Cost segregation is a strategic tax planning tool that allows real estate investors to increase their upfront cash flow by accelerating depreciation deductions. This process involves breaking down the cost of a property into various components that can be depreciated over a shorter tax lifespans than the building itself. Cost segregation is a strategic tax planning tool that allows commercial property owners to increase their upfront cash flows by accelerating depreciation deductions. This process involves breaking down the cost of property into various components that can be depreciated over shorter tax lifespans than the building itself. So, definition and the process at its core. Cost segregation is about identifying and reclassifying parts of a property to more rapidly depreciate certain costs over 5, 7, and 15 years instead of the standard 27.5 or 39 years for the entire property. This classification leverages IRS guidelines to classify assets into four main categories. The first category is personal property, assets that are not a part of the building's structure and can be easily moved, such as carpets, removable wall partitions, and specialized plumbing systems. The number two is land improvements, items outside of the building but on the property, like landscaping, outdoor lighting, and the non-structural improvements to parking lots. The third is building and structural components, the physical structure of the building, including walls, floors, ceilings, and any other permanent structure. The fourth is the land, the ground upon which the property sits, which is not depreciable. So the benefits or of the cost segregations, if we talk about the benefits, the primary benefits of conducting a cost segregation study is the potential for significant tax savings achieved through accelerated depreciation reductions. These benefits include: the first benefit is reduced tax liability. Accelerating depreciation expenses result in lower taxable income during the initial years of a property's life than enhanced cash flows. The tax saving realizes frees up cash for other investments or the operational needs, improving the overall financial health of the business. Then retroactive savings, look back cost segregation studies can be utilized to catch up missed accelerated depreciation from the previous years. So what is the applicability? Cost segregation can be applied during the construction, purchase, or renovation of the property. It is most effective when implemented in the first year of the ownership to maximize tax benefits, but can also be conducted retroactively on the properties acquired in the previous years, whether renovating an old office building, constructing a new hotel, or purchasing a warehouse. Property owners across various industries can utilize cost aggregations to realize considerable tax advantages and enhance the financial performance of their real estate investment. So Talking about historical context and the legal framework, historical evolutions, cost segregation has its roots in the 1980s when the US Internal Revenue Services IRS officially recognized and formalized the process. However, the practice of segregating property cost for tax purposes has been around for several decades, evolving through the various tax laws and IS rulings. The concept initially emerged from the investment tax credit laws applicable to personal property in commercial buildings, which led to the need of for detailed cost analysis. Then the legal framework for the cost segregation was solidified with the Hospital Corporation of the America HCA ruling in 1997. This landmark case against the IRS set a precedent that allowed property owners to segregate the cost of a property into different components, paving the way for the modern cost segregation practices. The ruling confirmed that certain parts of a building could be considered personal property or the land improvements, thus eligible for accelerated depreciation. So, what are the IRS guidelines in this case? Following the HCA decision, the IRS issued further guidance to help taxpayers understand how to properly conduct cost segregation studies. The most significant of these guidelines came in 2004 with the publication of the IRS Cost Segregation Audit Techniques Guide. This guide provides a comprehensive framework for how cost segregation should be performed, detailing the proper classification of buildings components and the documentation required to support depreciation claims. The guide outlines several key aspects. For example, the first is property classification, detailed descriptions of property types and how to classify them for tax purposes. The second is documentation standards, requirements for the documentation needed to substantiate claims, including invoices, contracts, and the construction plans. The third is quality of the study, standards for the quality of a cost segregation study, emphasizing the importance of engaging qualified professionals to ensure accuracy and the compliance. Then comes regulatory updates. Since the issuance of the Audit Techniques Guide, there have been several updates to the regulations surrounding depreciation, notably through the changes in tax laws like the Tax Cuts and the Job Act of the 2017. These updates have often included modifications to and the depreciation rule, such as changes to recovery period and the eligibility for bonus depreciation, which can significantly impact the outcomes of the cost segregation studies. What are the current applications today? Cost segregation remain a vital tax strategy for the property owners looking to maximize their tax benefits. The process is supported by a well established legal framework that continues to evolve with changes in tax legislation. By understanding this historical context, the legal framework, property owners, and the tax professionals can take advantage of the cost segregation with greater confidence and precision, ensuring they are fully capitalized on the available tax advantages. When to conduct cost segregation study? If we talk about this point, conducting a cost segregation study at the right time can significantly enhance its financial benefits. Here's when it's most advantageous to consider undertaking one. So when to conduct the cost segregation study during the purchase of a property, following new construction or renovation, during a refinance or reassessment, prior to tax year closing, and then retroactive application during the purchase of a property. The first point in this is optimal timing. Initiating a cost segregation study immediately after acquiring a property is often the most beneficial. This allows property owners to begin realizing tax savings from the first year of the ownership, maximizing cash flows yearly in the property's life cycle. Then comes documentation availability. The right after a purchase, access to detailed cost and construction document is typically easier, and ensuring a more accurate and comprehensive study. Following new construction or the renovation, maximizing depreciation after the complete of the construction or significant renovation, many new assets can be depreciated over shorter periods. A timely cost segregation study can identify these assets, allowing for accelerated depreciation, deductions, cost verification. Post construction, all expenses are known and can be precisely allocated, making this an ideal time for detailed analysis. The fourth point is prior to a tax year closing, deadlines, advantages. Conducting a study before the end of a tax year can be strategic, especially if significant taxes are due. Accelerated depreciation can be reduce taxable income substantially in the current year. Retroactive applications catch up depreciation for properties acquired or constructed in previous years without a cost segregation study. The IRS allows taxpayers to catch up on the depreciation that they have not yet claimed without amending past returns. This is done through a change in accounting method, which can be applied in the current tax year, providing a substantial one time deduction. So, regulatory or the tax law changes, legislative changes includes the tax laws and the regulations can change, sometimes retroactively. Staying informed about these changes can provide opportunities for additional deductions through a cost segregation study, especially if new tax incentives are introduced or existing laws are modified. Deciding when to conduct a cost segregation studies involves strategic planning and consideration of your financial and tax situation. It's advisable to consult with a cost segregation professional or a tax advisor to analyze the potential benefits and determine the optimal timing based on your specific circumstances. Eligible properties and the practical applications of the cost segregation. What are the eligible properties? Cost segregation studies can be applied to a wide range of the property types, each offering unique opportunities for tax savings through accelerated depreciation. Here are the primary types of the properties that benefits from the cost segregation. The first one is commercial buildings. Office spaces, shopping centers, and warehouses can have significant portions of their construction cost allocated to personal property and land improvements, which depreciate fast. Residential rental properties, apartment complexes, and the residential rental units, while typically depreciated over 27.5 years, contain many elements that qualify for shorter depreciation periods. Then comes industrial facilities, manufacturing plants, and the industrial sites often include substantial amounts of the machinery and equipment that qualify for accelerated depreciation. Special purpose properties, this category includes hotels, restaurants, and recreational facilities like golf courses, where specific facility features can be segregated and the depreciated more rapidly. The fifth one is healthcare facilities. Hospitals, medical offices, and the assisted living facilities can benefit from cost segregation, especially given the extensive use of specialized equipments and the fixture in these properties. Than educational buildings, schools and universities often involve complex constructions that include elements like laboratories, libraries, and dormitories, which with assets like eligible for the faster depreciation. The practical applications are understanding how cost segregation applies to different property types provides a clearer view of its practical benefits. Here's how it translates into a real world application. Tax deferral. By accelerating depreciation, property owners can significantly reduce their tax liability in early years of a property's life, enhancing cash flow when It may be most needed for the reinvestment or debt services. Improved cash management. The immediate increase in the cash flow can provide property owners with more flexibility in managing operations, maintaining properties, or investing in the further property improvements. Investment return enhancement. For investors, the increased cash flow from the accelerated depreciation can improve the overall return on the investment for a property, making real estate investments more attractive than the cost reassessment during renovation. The remodels. A cost segregation study can identify previously missed opportunities to segregate cost and claim past depreciation, potentially leading to significant retroactive tax deductions. Then comes the strategic planning for new constructions. Incorporating a cost segregation study into the planning phase can influence design decisions that maximize tax benefits, such as selecting building materials and the systems that qualify for faster depreciation. Then comes out the most common approaches utilized for these cost segregation studies. Cost segregation studies can be complex, involving detailed analysis to identify personal property assets eligible for the accelerated depreciation. To achieve this, professional employ several approaches professionals employ several approaches, such as each suited to different types of the projects and investment scales. Understanding these methods can help property owners choose the most appropriate strategy for their specific needs. Here are the most common approaches used in the cost segregation study. First of all, detailed engineering approach from actual cost. Detailed cost approach. This method is the most precise and involves a detailed analysis of all costs associated with the construction or acquisition of the property. It relies heavily on the construction and accounting records to identify and reclassify each component of the property accurately. And then professionals will examine invoices, contracts, and payment applications and the blueprints to segregate cost into personal and real property categories. This approach is particularly effective for new constructions or major renovations where detailed documentation is available. Than residual estimated approach. In scenarios where detailed cost data is unavailable or incomplete, the residual estimated approach can be applied. This method starts by identifying and valuing all personal property items, subtracting this from the total project cost and allocating the remainders to the real property. This approach is less detailed and relies more on the on estimates that actual cost records, making it faster and less costly but potentially less accurate than the detailed engineering approach. The third is survey or the rule of thumb approach, often used for a smaller projects or when a quickly analysis is required. The approach involves applying standard percentages to the various components of property based on the industry rule of thumb. It's less precise and generally not recommended for large, more complex properties due to its reliance on generalized data rather than specific project details. Then comes cost segregation software approach. With advancements in the technology, some firms use specialized the softwares designed to assist in cost segregation studies. These tools use databases of cost and IRS guidelines to help categorize property components. Softwares can be cost-effective options for less complex properties and can provide quicker turnaround and than the manual. Overcoming challenges and ensuring compliance in the cost segregation. The overcoming challenges and ensuring compliance cost segregation, we will discuss the 4 points. First one is accurate classification, the second one is documentation requirement, and the third one is the changing tax laws, and the fourth one is audit risk. For ensuring compliance, here are the points to discuss. Engage qualified professionals, comprehensive documentations, consistent methodology, stay informed on the tax changes and pre-audit assessment, and then comes the regular update and reviews. So this was all about the article and how cost segregation reduce the taxes. So hope it will be beneficial for you. So subscribe my channel for more helpful videos. Thank you.